talking now with National Australia Bank's John Kyriakopoulos in Sydney. John, thanks very much indeed for joining us. First up, what do you make of what's been happening, and does the Aussie keep on appreciating?
Yeah, it's a good question. There's obviously a lot of focus on the Aussie, which, as you said, has hit a two-year high recently. I think there's a number of things that probably need to go right to get the $A substantially higher. And there's some unknowns out there. In particular, I would say there's some uncertainty over whether the Reserve Bank of Australia will hike interest rates again before the end of the year. We'll get a bit more of a take on that tomorrow with the Reserve Bank minutes. The market's pricing a reasonable chance that the RBA hikes. There's always some risk that they remain on hold for the rest of the year, although, to be honest, we think the RBA's got a lot more tightening to do in 2011, which would be positive for the Australian dollar. The other one is the other uncertainty is around whether the Fed restarts quantitative easing, and there again we'll get a bit more information on that with the FOMC minutes out around the middle of the week. If the Fed were to go ahead and restart quantitative easing, I think the US dollar could fall quite sharply, and that would push the A dollar up to new highs, potentially as high as 96 cents. And then
I mean, we've got a story, John, at the moment suggesting that the Aussie is the most overvalued amongst all the G10 currencies. You know, what's your take on that?
Yeah, it's interesting. Personally, I'm not a big fan of purchasing power parity applied to the Australian dollar. There's a couple of reasons around that. Essentially, Australia's major exports are commodities rather than manufactured goods. You tend to find that purchasing power parity works a lot better when it does work, and there's a lot of evidence it actually isn't very successful in working out currency valuation. But 65% of Australia's exports are commodities. So, for example, commodity prices would need to fall by about 2/3 from current levels, which would be a massive decline. You'd have to believe that Chinese growth would grind to a halt and stay very low for a number of years, which personally I don't believe, to have an argument that the Australian dollar is significantly overvalued. I would make the point that Australia's actually now running a trade surplus in goods and services, in fact the largest trade surplus in 40 or 50 years. So that's inconsistent with arguments that the exchange rate is hurting us on the trade side.
Right, so is it a one-way bet, the Aussie dollar?
Oh, it's never a one-way bet. As I said, there are some uncertainties around the China growth story and how much China slows. If anything, I think the risks are that we might see a re-acceleration in Chinese growth in the fourth quarter. So it's a soft landing rather than a hard landing. And then we could see another leg up in traded commodity prices. A lot more uncertainty over whether the US restarts quantitative easing, I grant you that. And there's a more uncertainty over whether the Reserve Bank will hike rates by the end of the year. So we may only get one of those three potential positives for the A dollar, which may push us up another couple of cents. If we were to get all three positives, re-acceleration in Chinese growth, quantitative easing by the US and the Reserve Bank hiking by year end, we could actually trade up to, the pre-GFC high of 98.5 cents.
John, let's just have a look at the yen as well. I've got comments from the Bank of Korea. Now, the central bank governor there is Kim Chu-song, and he says if Japan can't stem the appreciation of its currency on its own by acting alone, do you go along with that?
There is some truth in the sense that, historically unilateral intervention hasn't been that successful, although I would probably make the case that's probably more true when you're trying to defend your currency rather than weaken it. I think you can act alone and try to at least stop it appreciating, I should say, rather than weaken it. I don't think Japan's trying to institute a competitive devaluation, which obviously wouldn't be well accepted by the major economies, whether that's true in Europe or the US. I personally think they might find the authorities in Japan will find it a bit of a struggle if we were to see the US economy continuing to weaken, so the unemployment rate in the US headed higher, and then the Fed would have to restart quantitative easing. I don't think unilateral intervention by Japan would then stop the yen from reappreciating.
Very quickly, John, where do you see it going? I mean, does it weaken further, or do we see it resume its trajectory upwards?
Yeah, I think for the moment, the top side I see on dollar yen is probably around that 86.5 mark, and that's really because I do think there is some chance, albeit obviously not 80 or 90%, that the Fed does restart quantitative easing before the end of the year. And because that's in investors' minds and they're on alert for QE2, if you like, I think that will cap dollar yen gains. And in particular, you can't really see dollar yen appreciating substantially while US bond yields remain extraordinarily low. So I think the Bank of Japan's probably reasonably happy with its efforts to date.
John, thank you so much for joining us. John Kyriakopoulos there joining us from Sydney.